Good morning, everybody. March 2nd, 2024. I successfully beat COVID a couple of weeks ago, and somebody decided to give me a cold. So I go from nasally Wisconsin person to extra nasally Wisconsin person. I apologize. I had to cancel my haircut, so I'm very fluffy under the old man cap, but that's what we're going with today. So I've been updating the Fundamental Trends website a little bit with my team in Mumbai, and they're pretty much fired because they're so hard to deal with. But got a little bit of a new look, some different colors, new theme, right? Gonna try to make this kind of like taste great, less filling, more profits, less risk. And I want everybody to consider inviting your friends. There is a affiliate program. So if you're not signed up as an affiliate and you are a member of Fundamental Trends, you should sign up. The bar across the top you should not see anymore unless you're an editor or me. So all your tools will be here. If you want to go to groups, your groups will pop up. Site's a little slow today because I erased all my cookies, so these are first loads. Go to all your groups. The macro dashes and special reports, that is open to anybody registered for the site. So go ahead and join that conversation. That's for free members and everybody else. And again, I do encourage you to become an affiliate because the commission's 15%. You get 7 referrals. You're basically free. If you are a lifetime member, then you just start making money. All right, let's talk about, and right now I'm running a spring training special on the sustainable growth trends. You can get the sustainable growth trends for 50% off. The retirement income options is also 50% off. So if you want to try this on for size, if you're not a swing trader, you go ahead and click this. You can see all of our memberships. Rare includes swing trading. Retirement income options is basically the same as margin of safety investing over at Seeking Alpha. Sustainable growth trends, if you're really just trying to build wealth through growth stocks. Global Trends ETF is bundled into everything else. And then the free special reports library that you can see just for registering for the website. And pretty much everything has some sort of half price deal. The Global Trends doesn't. So you can get sustainable growth trends for the same price as Global Trends ETF right now and get all the growth stocks, which I am releasing the updated list tomorrow or Monday. Just finishing it up. Had a couple of new ideas. Shooter is doing a chart book for you, so we'll have all sorts of good stuff. All right, what about what is going on in the world? So I wanted to talk about the rally that we're seeing now. At the start of the year, I said there would be a rally to start the year. Permabear sees a rally, angst, and euphoria in 2024. So far, through the first 2 months of the year, we've seen the rally. I think that we probably have a week or two to go. What is going to trigger the angst? Well, let's talk about that. Over at Goldman Sachs, they're talking about the return of the go-go chaser, YOLO, just bet on it going up group of investors. And that is the new reality. I had a talk with a client yesterday, and he pointed out that value investing seems to be dead. Well, that's the same thing that I've been saying, and David Einhorn has been saying, and a lot of people have been saying. And it's not entirely true. However, there is an element that has become more pronounced. So nothing's different. It's just more extreme. In the past, you could buy a growth stock or a valuable asset at a cheap price when it was out of favor with the market. And usually within 1 or 2 years, the market would revalue it up. That has extended itself. It's not as easy to do anymore because markets are becoming more extreme. We have 50% of the people who index. That means that they essentially invest almost all of their money into the biggest 50 stocks in the market. That is because the indexes are market cap weighted. So the S&P 500 has about 35-40% of it in the top 10 stocks. The top 10 stocks, of course, are your Magnificent Seven, Salesforce, and a few others. So market cap weighted indexes lead people to be overly concentrated in the biggest stocks. I don't think most of the people who index really realize that. I think that they think they're diversified. They're not. They say, well, I invest in the S&P 500. I'm diversified. Not really. The top 10 or so stocks account for most of the movement in the index because the market cap weighting gives them the heaviest weight. They are, like I said, 35-40% of the market when it comes to creating the movement. So if half the people are piling into the biggest stock, That means they'll go up when there's liquidity to pile in with. And that's the thing that people don't get. As long as there's liquidity to put into the market, the biggest stocks will go up. And until they get so expensive that smart money starts to move into other asset classes, that's where your leaders are going to be. So what we have seen in the last year or so, year and a half, is that the mega caps, the biggest companies, have gone up and Bitcoin has gone up. So we called the Bitcoin. We talked about investing in QQQ. So if you were following the asset allocation recommendations where I said you can have up to a quarter of your money in QQQ and you should really throw a hunk in Bitcoin, you probably have done pretty well. I have continued to want to buy some of these small cap stocks. And the small cap stocks as a group have not done well. However, you still get some big winners. And the big winners are in your growth companies that are actually growing and turning profitable, as well as your micro caps that jump onto the Russell 2000 and your mid caps that jump onto the S&P 500. The small cap indexes don't work. They're dysfunctional. Why? Because there's 2,000 stocks in the Russell 2000 and there's not enough money to buy the entire index. So to be a small cap investor, you have to basically pick your winners. So I've been trying to do that, but until there's money that flows or rotates in the small caps, and we've started to see that, they're not really going to follow along. Because, of course, even if a company makes money, until people discover it and start investing in it, stock price doesn't go up. So what we're seeing is that we need to be, just like with inventory, we need to have to be more real-time investors. We can say, hey, here's a great idea. Here's Rocket Labs or Spire Global or Ametis. And we know that in 2, 3, 4 years, they're going to just be stacking up revenues and profits. But until people see it, because almost none of the investors in the market, which is why most people fail and aren't rich, they don't look forward. The forward-looking approach of most people is to look backwards at the last year's performance. Oh, look, that went up last year, so I'll buy it. And that's why you usually get 2 and 3 year rallies, is because the FOMO comes in. So until the small cap stocks start to go up, or a particular small cap stock goes up, it's not going to move much because nobody's discovered it. The vast majority of investors that move the needle, the money at the margins, are your FOMO investors. So we have to try to use not only the ability to find a growth company trading at a value price, which isn't the hard part. It is getting in there 3 or 6 months ahead of time instead of 2 or 3 years ahead of time. That's the hard part. Some of the stocks that I bought in 21 and 22 and 23 are just starting to go up. So you have not missed an opportunity here. Some of the stocks that I have on the growth stocks list, if you haven't bought them yet, there's a psychology that you have that most people have, which is, well, it hasn't gone up, so I'm not going to buy it. It must be a wrong thesis. No, the theses are not wrong. I have been 3-1-1 in my career on the small cap stocks that I pick out. What does that mean? I win 3 times, I tie once, and I lose once. And the losers we mainly get rid of before we lose, a lot. So if you want to invest in some of these companies that I've been getting into for the last couple of years, I think you're lucky that you haven't in some cases, and you have the ability to buy them now, especially when the next correction in the market comes based on liquidity. Well, what's going to cause that? Well, over at Goldman Sachs are talking about that. In this article, he actually talks about skew. And this is a chart that I showed you, very similar to the one from FS Insight a couple of weeks ago, right? It shows that every so often we get a step down in the market. And we're probably within weeks, I think, of the next step down in the market. What will cause it? Well, probably the dollar. Because at the Federal Reserve meeting in 2 weeks, so I'm giving you 2 weeks, you're probably going to see the dollar jitterbug up a little bit. Why? Because Jerome Powell's probably going to be mean. He is going to talk about how there was a slight uptick, a very small uptick in inflation, and he wants to make sure that inflation is not a problem. I understand. That's great. But the reality is that inflation just isn't a problem. And what he is going to fight is the urge to cut by justifying not cutting with inflation. Here's the dichotomy. The big problems with the U.S. economy are twofold. One, we have $34 trillion of debt, and I'll talk about that in a minute, and we're paying on it. Granted, a lot of that money is just paid back to ourselves, but there is still an interest expense. And there's a crowding out effect that gradually happens over time. If you ever took economics, you understand what crowding out means. It means when the government uses too much money, there's not enough money for private enterprise to do things in the economy that need to be done. One of the things that's not being done right now is there's not enough residential housing being built at the same time that we are aware of. And, there's a right wing that fights this. But the reality is that economically, we need a lot of immigration because baby boomers are retiring, not only leaving the workforce, but at some point will need to be taken care of. The minimum estimate I've seen for the amount of immigration we need over the next generation is about 30 million. I think it's probably a little bit higher. But let's say 30 million people come into the country over the next 15, 20 years. Where are they going to live? So that's a lot of housing units. Divide that number by about 3. We need probably 10 million housing units minimum to be built over the next decade. And we're not on pace to do it because financial conditions are just a little bit tight. They're not real tight. There's an article on Seeking Alpha this week that talked about how financial conditions had loosened up. And they have loosened up on anticipation that the Federal Reserve will cut rates. And the article that was written said that the Fed had lost control. The Fed hasn't lost control. Just the markets being markets, traders being traders. It happens all the time. You can see that where we are now, there's plenty of times where financial conditions are easier. And also on the recessions, financial conditions get real tight because capital dries up. So the most recent example of a huge capital dry up was COVID. But really the big one was the financial crisis and then killing inflation in the late 70s, early 80s. So right now, financial conditions are about normal. People bitch and moan about normal, but they're about normal. The dollar is probably a little bit high. So if the dollar ticks up, then financial conditions will get just a little bit tighter. Why would financial conditions tick up? It would be because the Federal Reserve says, hey, we're not really sure when we're going to cut interest rates. And if he doesn't start to reduce the amount of quantitative tightening, what if he delays that next week or in 2 weeks? What if we don't get an announcement that talks about cutting quantitative tightening imminently? What if he says that it's something for the next meeting? Then that means from the middle of March to the start of May, we have 6 weeks where I think financial conditions tighten up and we might get a little stock market correction. You would want to buy that stock market correction. In the meantime, I told you last week to write covered calls on positions to get through that little dip. So selling covered calls this week while you can is a great idea. I will write another retirement income options talking about selling covered calls. And in the chat room, you should ask me, hey, I own this or I own that. Should I write a covered call? Well, the first thing you should do before you ask is go to your TradingView subscription and just check to see what does RSI say. So if you pick out any stock, Microsoft, for example, take a look at Microsoft. Let's just look at the last 5 years. Start adding some of the indicators. What we see here is relative strength index is getting pretty high. It's peaked, it's pulled off, it's peaked, it's pulled off. Probably isn't going to set a new high. Might, but relative strength index on a weekly chart, right? Not daily. This is measured by week. Daily, right? As the daily gets up and you can see the trend is lower highs, probably this is the week where you want to start writing covered calls on a lot of stuff because a lot of the charts look like this. The daily chart, lower highs. The weekly chart is probably peak and the new high will be a little bit lower. And the weekly will start a trend of lower highs. So you want to write covered calls on a lot of stocks. Yell out a stock. What stock do a lot of you own? Give me one. What's a popular stock that you own? No, not Berkshire Hathaway. I mean, Berkshire Hathaway too. I mean, you probably just want to sell a share. On some of these high price stocks, what large cap stocks do you own to pay you a dividend? What do you own? Bristol Myers. You don't want to write a covered call. It's not expensive enough. Pfizer, not high enough. Intel, there's a good one. Intel, you probably on a little bit of a rise this week, it wouldn't hurt to write a covered call on Intel, especially with Intel because we know that it's a few years out before they really start benefiting from the new construction and the tax breaks. I actually trim my Intel. Costco, you ought to just be selling some of your Costco stock. I mean, that's not just a covered call here. I mean, you ought to sell some of your Costco stock. Let's take a look at the monthly. The monthly is super overbought. So I'm telling you right now, you ought to be selling some of your Costco stock, period. Stock price always follows these peaks downward. Always. 100% of the time. There are no exceptions. Don't try to imagine there's exceptions. There's not. Never. It's overbought tremendously. So you should be selling Costco. You don't have to sell it all, but if you have a profit in Costco, say you invested $50,000 and now it's worth $100,000, you should sell $50,000 worth and maybe part of your original principal if it's still too much. Or maybe you sell everything that's profit and then write a covered call on half of what's left. This is why TradingView is so valuable and why I keep telling everybody to have it, because you can measure the different time frames and get a pretty good feel on where these things are. Costco is tremendously overbought. Here, I'll show you something else. I bet that this shows that it's overvalued. So if we go to fast graphs, which I also use, I don't show it very often, but I thought I should. So here's Costco. I want you to understand this chart. That's share price. Typically, share price hugs operating revenues. As operating revenues go up, price goes up. And it is dissociated itself. What does that look like right there? What is that called, folks? What is that? What animal's jaws are those? Those are alligator jaws, folks. Costco's going to come down. So you'd be out of your mind not to trim your Costco. I'm being honest with you. You'd be nuts not to sell some Costco. Nuts. Knucking futs. You'd be. This is screaming at you to sell some Costco. We know what the path of their operating earnings are. It has way too high of a valuation. No, Oscar, one of our viewers says, I'm tempted to short it. No, you'd be knucking futs to short a great company. Don't short great companies. Don't ever say it again. Not you, not anybody else. A lot of people talk like that. Stop doing it. You're going to get burned if you try to short a great company. There are so many shit stocks out there that have similar setups. Short the shit stocks by knowing what you're doing. Say, oh, that's a shit stock. It's overvalued. I'll short that one because it's overbought and overvalued. You don't say I'm going to short Microsoft or short Apple or short Costco. If you want to short the big mega caps, then go ahead and short the S&P 500 index because that'll come down to, and you don't have individual stock risk. The individual stock risk comes from, what if Costco announced that they're buying Target and it goes to the moon? So while it looks like this is going to go down, you can't put it past a great company to do great things. So don't ever short a great company. I'm tired of hearing people talk about it. Don't do it, period. Go away if that's what you want to do. It's a stupid move. I make that clear? I'm tired of hearing it. At the start of the year, I talked about angst. The angst is going to come from Jerome Powell. And he has to make the market believe that he might not do much for them this year. Torsten Stock over at Apollo talked about it this week. Now, Torsten is a market mover. He moves markets. So when he says something like that, enough people are going to listen. And because they don't have minds of their own, they'll just follow along. So you're probably going to see a bit of a correction here starting in the next couple of weeks, probably right after Jerome Powell opens his mouth. So trim stocks that you think are overvalued or overbought, or write covered calls, or a combination of both. The small caps don't fall into that category. You know, take a look at some of ours. Spire Global, right? This is a daily chart. Take a look at the monthly. You know, it's still in the middle. The weekly, a little bit overbought. So you don't want to buy Spire Global right now, but you don't want to sell them either. Why? Because you know something about the company. You know that they're stacking up revenue after revenue after revenue, and they're down a ton, right? They're at the front end of a rebound. Why would you short that? You might not buy it because you know it's a little overbought right now, but if it comes down just a little bit, you probably buy it, right? That's a minimalistic move. It's got all this room to, and I don't know if it'll get up here, but it needs to get to about here. Spire Global is heading into the 60s or 70s in the next few years. So you may not buy it at 1248 because you're a little bit more impatient than the next guy, but you certainly should not be selling it, right? Because fundamentally, you know that this is the path. Might have a little hiccup, might drop, you know, to 11 something. So start thinking this stuff through in a critical manner and know the companies that you're investing in. Don't short great companies. Don't sell small caps that haven't hit their big ramp up, their big adoption curve yet. Just look for overvalued mid and large caps, mainly large caps, and trim or sell them if you own them. Look for this sort of thing. How many of you have seen fast graphs before? I mean, they get stuck in articles all the time. I've been using Stock Rover and other stuff, but I recently subscribed to this just because I think it's easiest to look at, right? So this one's easy to look at. I've shown this with different systems before, right? I've shown it with Stock Rover. So I switched from Stock Rover over to Fast Graphs because Fast Graphs is easier to use, basically. They're similar systems. We got Stock Rover, just figure out how to do this. That's real easy, right? Price tracks operating revenues, and then a little bit of margin expansion, a little bit of profit valuation expansion. But then when it expands too much, it's going to come back down into here somewhere. Probably still be above the blue line, unless there's a market correction that knocks everything down. So everybody wants to talk about the federal budget. I have talked to you a number of times and said, look, it's not the spending that has caused the federal budget problem. It is basically the tax cuts. The tax cuts are virtually 100%, almost 100% responsible for the budget deficit. So when the Trump tax cuts expire next year, there's going to be a negotiation. And the negotiation is going to have to do with what parts of the tax cuts to keep. And I think they're going to keep the SALT cap. I think the $10,000, maybe they bump it to 20, so that people in New York and Connecticut and California can deduct their state and local taxes up to a certain amount. That's going to happen. It's not going to go back to unlimited. So that's actually a revenue generator. So they'll have some sort of cap on SALT. Maybe it's not 10,000 like it is now. They have talked about 20,000 and 30,000. I don't see a lot of reasons why we need to have a real high SALT limit. And here's why. It is good for the country that people migrate from the coasts back to the interior. Not everywhere. There's people who just want to be in New York or Connecticut or California. But the difference in living expenses on the coasts, I mean, you can really pay triple to live in certain places versus living in the Midwest. And you could say, well, that's because those places are better. I'll tell you what, I've been to almost every place. You're going to have a hard time finding better places to live than around the Great Lakes. In fact, I would say that one of the best places to live would be like a Cleveland or a Buffalo or a Milwaukee. You have a Great Lake, you have a little bit of winter, and you don't have a shortage of anything, and you don't get the gigantic weather events that you do on the coasts. So when people ask for these big SALT deductions, you're really subsidizing wealthy people. And we're trying to get away from subsidizing people who shouldn't be asking for a subsidy. So I would think that there will be a limit on SALT deductions. Now, the standard deduction helps people from the bottom up. So I think that they find a way to keep the higher standard deduction. But the tax rates will probably go back to the Obama era. And if we were smart, remember the last time we balanced the budget was for a hot minute in 1998 and 1999. We had the combination of high tax revenues because of the stock market rally, but also because rates were just a little bit higher in the Clinton era. If we go back to Clinton era taxes, we would balance the budget overnight. Now, do we want to do that? I don't think so. I don't think we want to go that far back. Obama era tax code is probably where we want to go because that would cut the deficit roughly in half and a little bit more in years where tax receipts are up because of stock market and real estate appreciation, which can happen when interest rates get cut. All right, so if we can solve about half of the deficit problem just by going back to the Obama era taxes, how do we fix the other half? Well, a combination of low interest rates, immigration reform, right, getting those people on the tax rolls because they're going to be working, and allowing just time to balance out the demographics, which is a very long-term thing, probably works. And you're going to see the Federal Reserve go back to quantitative easing at least for a while at some point, because they will have to be the bridge. And then there will be angst about the Federal Reserve balance sheet expanding to 10 and 12 and 15 and $20 trillion, which is money that we owe ourselves, not outsiders. We just owe ourselves the money. But it is borrowing from future generations to a certain extent, but you spread it over a very long period of time. So everything that's going on right now is very fixable. Federal Reserve knows it's fixable. The government knows it's fixable. They're fighting over things that really you don't need to fight over. The one thing that certain people want to convince you of is that we need to cut spending. And the reality is that we don't. The only thing that we really need to cut spending on is defense. But we can't because things are going on. So what do? Well, you can probably flatten the defense budget and over a very long period of time because of the value of money, right? Inflation. It ends up being a positive net effect. But that'll take a decade or 15 or 20 years. So can we spend the same amount on defense for a decade without raising it? I would think it's pretty easy to do. At some point, that's what we have to. And if we don't, then we will do to ourselves what we did to Russia, actually what we did to the Soviet Union in the 1960s and 70s. We forced Russia to have very bad economic policy by playing back at them, just like in a poker game. You play back at them, you make people bet more than they want. And then the USSR went broke. So we can avoid going broke by simply not spending ourselves on the defense side into oblivion. Medicare is largely going to be addressed by AI, going to cut the expenses in healthcare. And Social Security is pretty easy to fix. There's not a big problem with Social Security. So anybody who says there is just doesn't know what they're talking about. It's 70% funded for like a century. So we just have a little gap to fill. We can do that by changing the full retirement age. Maybe having white collar workers not be eligible for early retirement. Pretty easy. There's not much to it. Create a bigger donut hole. Once you get to a certain amount of income, you start paying the Social Security tax again. Right now, it's gone at like $154,000 in income. All right. So, short story. Expect mean Jerome Powell in 2 weeks, and that should trigger a small stock market correction. Between now and then, look at trimming some things that are overvalued and overbought, right? The small caps are not overvalued, but you have stocks out there that are overvalued and overbought. So go ahead and trim those. And mainly they fall into the, companies over $100 billion in market cap for the most part. So, all right, everybody, look for a couple of articles basically saying expect for there to be angst in the markets starting in a couple of weeks.